Chuck. Now, we don't give direct trading advice. We give structure advice. We give management technique advice. We don't analyze a lot of positions. I had a couple of questions come in, not on this one, but on other positions as well. No problem, Chuck. No, I'm not trying to throw your question off. It's just not something I can give in. Chuck says, would you consider getting into PBR? It is something that came up on a, gosh, was it a covered call screen? Or maybe it was a long caller I was having a discussion with a customer with. He says, dividends appear to be incredible. Yeah, this is similar to REIT status. It's monthly, right, Chuck? That's why it's a 13-cent last dividend. The annual dividend is 3.90. So this is a Brazil foreign stock position, petroleum naturally, and it's a 29.9% dividend on the position. And if you take a look at the stock chart, we're at 12.65 now, down 40 cents. Might have paid the dividend today. Did I see the date? Oh yeah, it was 11.3. It was yesterday, so that's probably the effect. That 40-cent drop, market conditions, even though mostly up, but also yesterday, of course. Oh, that was earnings. Hesitation on this one. Okay, I've got hesitation on this one. Hold on. So what I'm seeing here is confusing me. Chuck, maybe you have better insight into this. We can do some research on it real quick. The annual dividend says it's 3.90 or 29.9%, but I'm showing a last dividend, which is showing on 8/12 of only 14 cents, meaning the next dividend should come out November 12th, right around, and it'll only be about 14 cents unless we have the wrong numbers. The 14 cents per quarter does not equate to 3.90. So this could have been a special dividend that was paid, Chuck. I'm not sure. If a special dividend was paid in 2022, it'd be reflected in this, meaning that the actual true annual dividend for this position might just be that 14 cents times 4, which is 66 cents. No, I'm sorry, 56 cents. My apologies. Would be 56 cents total, not 3.90. This looks like it might have been a special dividend payment where no guarantee you're going to get that extra 2.40 special dividend from Petroleo Brasileiro going forward. It's highly possible that this dividend price might be wrong, and this last dividend date might be wrong. It might be being paid monthly at 14 cents, but still, that doesn't verify. Okay, you said NASDAQ reports varying dividends. I think those are special dividend payments that you're going to have to look into, because there's no guarantee it's going to be the same. But they might, yeah, like you said, maybe the way that they pay is every other quarter, instead of 13 cents, they pay $1.60 or something. I don't know. I'll take a look at that deeper too. We can take a look deeper now too as well. But in some of these cases, let's see. This is a $12.65 stock. Great. Now, because I do this so often, Chuck, okay, I do have the wrong numbers. Peter says the last dividend on August 12th was 2.58. 8.2 paid 2.59, not consistent. Lisa, thank you. Okay, so that was it, Chuck. My dividend number is wrong because it was a special dividend. This is the regularly quarterly dividend. Lisa pointed out on 8.2. So the last regular dividend is 8.2 was the special dividend of 2.59. And Peter says it was the 12th, it was 2.59. Okay. So that was a 2.59 special dividend. So Chuck, this is not going to be the same dividend consistently quarter by quarter. That was a special dividend payment that varies, as you mentioned, and is not consistent. However, is it priced in? And Lisa, you know this story because we've talked about it. Because I trade these so often, and since 2008, you hear me talking about the married puts all the time, but even looking at covered call returns, it's really more affected in the married put or in a collar strategy, meaning what? If I opened a regular, I'm sorry, I got to go back here. It's a PBR. If I look at a regular $12, $13, $14 stock with a 40, 50-day volatility, pretty high, around 0.59, 0.61 or so, I'd expect that if I open a standard married put following my structure, the structure in the blueprint, I should say, that I'd still be at a reasonable risk of around 6 or 7% going a couple strikes in the money in those cases, as we normally would, and going 5 or 6 months out in time. But if I just want to go to PBR, first one that's at least 150 days out is April. Let me go to more results. And you see here that the dividend is priced into the puts. How can I tell that? A 0.72, this is pretty high for implied volatilities on these put options. 0.6 volatility on the stock is not too bad. So we're talking about a $12.65 stock, 50-day volatility of around 0.60. Going 2 strikes in the money, I mean, just 1 strike in the money is still a 14.6% risk. Going up to the 16, that's a really wide bid-ask spread, so that's up at 20%. That's not accurate. It'd probably be lower than the 14, but we need a more realistic bid-ask spread. And the April 15 is a terrible bid-ask spread. So let's just take middle of the road. Let's say it's 15, 16, 17% risk for this high dividend paying stock because of the special dividend, i.e. the dividend is priced into the put. Let me just go to the married put search here, our default screen. Do I have anything close? There's a $20 stock. Flex is a $20 stock. But here, look, out to April, just going at the money is only 7.7% risk. ONB, Old National Corp, a 9.3% risk, again, at the money with the 20 strike. Implied volatilities are much lower, 0.28, 0.41 on Flex, not too bad. Let me just take the lists out of our default married put search. Let's go to fundamentals. Let's go 10 to 13. So we're going to open up the universe of options here, see $10 to $13 stocks, similar to PBR, with our initial structure, and good volatilities, 0.58, 0.63. Where are we? Coursera. 1270, pretty much equal price to PBR. Going out to the May 15 strike, a risk of 9.1%. We were seeing risks of 18 or 19% April expiration shorter term on PBR with the 14, 15, and 16 strikes. Here we're at 9. And 0.63 implied volatility versus 0.7. We're still in the wheelhouse. The high dividend, Chuck, is what I'm saying, is somehow still expected in that stock, even though, as you mentioned, and Peter mentioned, and Lisa mentioned, it's been varying because it's priced in. That's why you're seeing double the risk, if not higher, than we do on similar price stocks with similar volatility. Frontier Holdings, 0.55. Going out to May, going into April, staying in April, going a couple strikes in the money to the 15th strike, is 6.1% risk, where the higher dividend stock was at 18. So I'm not saying I would do it as a married put necessarily, Chuck. What I'm implying in this case is that when you look at a REIT or a high dividend paying stock, keeping the same structure that I would for a married put position if I was going that route, means the dividend is going to be priced in. The annual dividend price is going to be priced in. So I'm going to be seeing a risk of 17 or 18%, maybe 19%. If I stayed in it for a year, would I expect the 29% dividend to pay for it? Yes, but remember, on both Frontier, which is not the dividend paying stock, and on PBR, which was the dividend paying stock, we're not out of here. We're out to April, which is 5.5 months away. So you'd only receive about half of the 29% dividend, carrying the 18% risk. You might be looking at more of a break even as a married put position on a high dividend paying stock in that case, unless there's any good option premium with the calls that are available. 2 weeks out in time, let's keep it at that. Not bad at all for the stock here, 9%. I'm sorry, that went the downside. 2.5%, 1.3% for the 14 strikes, 17 cents or so. So remember, you're taking 1.3 every 14 days for 5.5 months, but the risk's at 19%. And you're going to get varying dividends, but yeah, that's the chance you take. I'm showing this structure just because in that case. And Lisa said, I traded the PBR married put After getting the 259 dividend, my long put dropped the similar amount, even though the stock price was higher. What she means is she was in the married put, the stock price moved up then above her cost basis, and the put dropped significantly because the dividend, without the stock moving up too much, the dividend sliced out of the put extrinsic value that was paid in. So she said this married put on PBR seems to be not working out well. And it's because of the structure initially that you take on a much higher risk. Now, I'm not saying that I might not do this this might be better as an out of the money covered call trade. If you wanted to get the high dividend and were confident that the dividend was going to come out more consistently than every 5 months or so, that down the road you're going to be able to see that dividend in that case, and trade it as an out of the money covered call or something along those lines, Chuck. That might be an approach that one would use. Covered combinations, someone mentioned, that's just doing the covered call but then selling an out of the money put to generate the income and then still collect the dividend, because that's not negated by selling the put. If you're still in the covered call, of course, and owning the shares of stock. But then you do have to worry about early assignment more often, but that's probably not a concern, but you might miss the dividend you're looking for if you get assigned early in that case.